Hey guys, this is Nick from Financially Aware, and in this video I want to talk about something crazy that's going on in the market right now where just 5 stocks make up 22% of the S&P 500. I'm going to talk about why this is bad and when the last time this happened back in 2000, what those 5 stocks were and what happened to those stocks now. So let's get started. This article is from Goldman Sachs, and they say they see an imminent momentum crash because of this concentration of these 5 stocks that now make up 22% of the S&P 500. And what are these 5 stocks? Well, let's look at them over here on a bigger chart. And here you see it is Microsoft, Apple, Amazon, Alphabet, and Facebook. And back in 2000, it was the only common stock between then and now is Microsoft. And back then it was Microsoft, GE, Cisco, Intel, and Walmart that made like 18% of the S&P 500, right at the top of the internet bubble. And so now we are here at an even higher level than we were during the internet bubble. So what does that mean? It means we could be in the same kind of bubble right now still, even after this market crash that we had, because the breadth of the market, meaning not all the stocks are participating in the bounce. It's only these 5 stocks that make up the large majority of the index that are leading the market higher. So let's take a look here that the distance below the 52-week high for the S&P is 17%, but the median stock in the S&P 500 is 28% off the 52-week high, which is a difference of 11 percentage points. And for all the different categories here, you see the difference between the aggregate index and the median stock is pretty big. I mean, consumer discretionary is 29 percentage points. So even though that the market has bounced a lot and is only 17 or so percent off its high, a lot of the stocks in the index have not bounced like you think they have. They're still a big percentage off of their high, 42%, 29%, 33%, 32%, energy 56%. So that's not a healthy market by any means. And let's take a look here. This breadth, the difference between the 52-week high less the S&P index median stock, the difference here is 11 percentage points, and it has happened once here around 2016, and here during the financial crisis, and here when it was 20 percentage point different during the internet bubble. So we all know what happened there, but let's take a look at some of these stocks, where they were then and where they are now. So the number 1 stock during the internet bubble and the highest market cap in the whole market, over $500 billion, was GE. And if you don't know GE's history, back in the late 90s, GE could do no wrong with Jack Welch. He was the world's best CEO. They had this Six Sigma thing, and they would fire 10% of their staff every year if they didn't improve, and all kinds of stuff. And he was known as the gold standard of CEOs. And look, their stock price was about $60 almost. Okay, that was in 2000. Fast forward to 2020, and their stock price is $6. So they lost like 90% of their value. So this was the number 1 market cap in all of America, and now it's down 90% 20 years later. Let's look at another one, Cisco. Cisco was even, you could argue that it was even a bigger stock than GE because it was the wave of the future with the internet and everything like that. And you see here, the stock was about $80 at its high, and when it fell to its low, it fell to like what, $7. So it also fell like 90%. And in 20 years, it still hasn't recovered. And recently it's like $40. So over 20 years, if you bought up here, you're down 50% on your money over 20 years. Now, Cisco is not just any stock. It was like the Apple of the 1990s. Okay, and it was also just like Apple was the first, I believe it was the first company to go to $1 trillion market cap. Well, 20 years earlier, Cisco was anointed and assumed to be that company to go to $1 trillion. It reached $500 million, but it crashed during the internet bubble, of course. But if you look at this article from Los Angeles Times, and there's plenty of them, this is February 13th, 2000. $1 trillion for Cisco, but not a dime for all else. And so it says, we're now asked to contemplate possibility of world's first $1 trillion company. And it would, of course, be specifically Cisco systems and all this stuff. And so it was assumed that they were going to go to $1 trillion. And you see 20 years later, they're 50% lower than they were in 1999. So those two companies, those two market leaders, number one and number two, are a basket case these days. I mean, Cisco's not a basket case, but it's not $1 trillion company. It's 50% less than it was in 1999. Intel was another one. It was one of the so-called four horsemen, also could do no wrong. And you see this run up. It was $75, split adjusted, whatever. But after it fell in 2003, it was like $12. So from 75 to 12, that's also, I don't know, 80% or something like that. And it's still, 20 years later, has not surpassed its 1999 internet bubble high. Okay, so that's 3 of these 5 stocks that made up almost 20% of the S&P back in 1999. They still haven't recovered. Let's look at Walmart. Now, Walmart here was $70, and after the internet bubble, it fell to like $40, so not too bad. However, it didn't recover above $70 for another 13 years. So it was basically dead money, or you were down 40% or so for 10, 12 years before it recovered. And now it's, $130. So maybe it's up 100% from its peak over 20 years. What's that, 5% a year or so? So not great either. Microsoft. Okay, Microsoft was $60 during the internet bubble when it made up almost 20% of the index along with the other 4. And it fell to $20, right? So 60 to 20, that's a $40 loss. That's about 66%. And you see, everybody's in Microsoft these days, right? But Microsoft was also dead money for how long? 17 years. It took 17 years from the top here for it to recover above $60. And so now it's $180. So it's up, 3 times over 20 years. But you had to wait 17 years, which I don't think most people had the patience to do. And you see, it went as low as $15 here, so from 60 to 15. It wasn't a guaranteed winner by any means. So that's that's all 5 right there, right, of the 1999 bubble, where those 5 made up 18% of the index. And now here we are today, and now we have 5 stocks that make up even more, 22% of the index. And those stocks are Facebook, which is trading at a 29 PE, not too crazy. Amazon, which is trading at 113 PE. And looking at Amazon from the 2000 bubble, it's up what? 20 times or so. However, you can't tell from here, but from the 2000 bubble, it fell over 90% to a low of like $5. So it was also dead money for a number of years, like maybe 10 years or so. So Amazon, pretty high PE. Google, which wasn't around during the internet bubble, they IPO'd in 2004. And their PE is 27, so not too crazy. Apple is, a standout. They weren't doing very well in 2000, I'll tell you that. But obviously, they've taken off like a rocket ship, and their PE is not crazy easy either, 23. And let's look at the SPY ETF, which is the S&P 500 ETF, and it's priced at like 1/10 of the actual index. And so in 2000, it was around 150 or 1500 on the S&P index and fell to 75. So it lost 50%, and it took 9 years to get back to about even, and then fell another 50% or more this time, and didn't recover until about 2013. So also dead money for 13 years. So what does all of this mean about these highly concentrated market caps at these times in the market? What it means is that these four or five stocks are carrying the market, while the rest of the market is kind of treading water, or even not even treading water. And so there's only so long that these 4 or 5 stocks can really carry the market to higher levels. Think of it like this. Let's say you have this drone that represents, the engines on this drone represent each stock in the S&P 500. And it's carrying the market higher. This shopping cart is the stock market and earnings and the price of the S&P 500 index. Okay, let's say instead of 8 little motors on this drone, there were 500 motors on this drone. And let's say that the motors could spin at a speed, anywhere from 0 to 10. And at a speed of 5, they're just kind of hovering. And anything above a speed of 5 is they're actually lifting higher, right? And out of these 500 motors, there's only 5 motors that are spinning at like a 10. And the rest of them are spinning at like a 5 or maybe even lower. Eventually, those 5 little motors are not going to be able to carry the whole weight of everything by themselves. And they're also going to eventually come down or go lower. So that's kind of where we are now, is that 5 small engines out of 500 is carrying the whole other 500, the weight of all the 500. So this never ends well, and this is why I always say, don't put all your money in one stock. And all of these people that buy whatever's hot right now, it always ends in tears, because the crowd is usually wrong. So whatever everybody is crowding into, that's usually the one that's going to underperform over the long term. And if you don't know about Cisco was the can't lose stock. Everybody at that time was doing like kind of like investment funds with their friends, investment clubs and stuff. And the number one stock in their investment club was Cisco. And after that was like Lucent and Nortel, all can't lose companies. Well, they did lose. Lucent, Nortel, they're bankrupt. So when things are elevated like this, they can't last that way forever, and they don't. And like Mark Twain said, history doesn't repeat, but it rhymes. And so something similar is going to happen to these 5 stocks eventually, that are now so concentrated that they're lifting the whole market forward while the rest of the stocks are lagging. So that's why it's not a good thing that these 5 stocks now make up 22% of the S&P 500. and seeing what happened the last time this happened and where we are even further along in this concentration, I would be cautious if I were you, and I definitely wouldn't load up a large portion of my portfolio into any one of these can't lose kind of stocks. So that's my video. Please give me a thumbs up. Let me know in the comments if you own any of these stocks and if you think they will be going higher or if they will be going lower. And if you haven't done so already, please subscribe to my channel. Thanks for watching.